She's selling Sacramento. She's selling Sacramento. Agent Key. She's selling Sacramento. Oh, yeah. Oh, yeah. Agent Key. Agent Key. She's selling Sacramento. She is.
Okay, you guys. Hey, y'all. I chimed in late. If y'all are tuning in, nobody's there yet. Darn me.
Which camera is it that's picking this up? Is it just the laptop camera?
It's right here.
Oh,
yeah.
okay.
Mm-hmm.
2 live.
Hey, Sacramento. It is Wednesday. You're listening to 97.5 FM KDEE. I am Agent Key, and we are selling Sacramento. I am finishing my fourth segment of our series, Home Loan Options That Work. In today's news, headlining in today's news, real estate market news you can use. Rising rates are biting the housing market. So today I'm going to talk a little bit about some stories that are trending right now in real estate headliners. And then we're going to go into, I'm going to give you the bad, and then we're going to give you the good. I was listening to, I forget who it was, but it was a minister. Y'all know how I get out early in the mornings and I do my power walking and exercising. And one of the comments that this minister made, he said, in God's economy, there is no recession. That your gifts and your talents are seeds implanted inside of you that can grow at any time. And he likened it to if you plant a seed during a recession, you plant a tree during the recession, it's not going to say, oh, it's a recession, I can't grow. That tree is going to grow no matter what is happening in the economy. And why did I bring that up? Because even though the economy shifts and changes, as it often does, it doesn't stop you from accomplishing anything. If you have the mindset, if you have the will, if you have the information, you can, should, and still move forward. And that's why oftentimes during recessions or during times that look like economic downturns, when it's over, some people just thrive, like go shoo, straight to the top. Those were people who kept their head down and their nose to the grind. And so the information that we share on this show is intended to help you keep your head down, nose to the grind, eye on the prize. Some of the story headlines today: home affordability has collapsed in 2022, and this is what to expect next, according to Bank of America. MarketWatch.com today has that headline out. And I'm pointing out these headlines because oftentimes we read these headlines and we hear 30-second sound bites and we determine our whole future based on these very strategically planted pieces of information that were designed to make you react. Right?
Yeah, they do. I react.
Right. And I do too. I did too until I realized that it was designed to make me react. And I had a choice. I could read it, take it in, file it, and say, okay, that's what they say. But what do I want to do? Here's another headline out there today: where the housing market is headed in summer 2022, according to experts. And that's Yahoo Finance's story. And I bring that up because down in the comment section of that story, somebody's saying these are the same experts that predicted the market was going to crash, and it didn't. And again, this, I don't know who the person was, but they're right. They're basically proving my point, which is be careful about these headlines and these stories. Real estate, as I often say on this show, is local. What's going on in the market nationwide may not necessarily be what's happening here locally. And we have to remember that. That's why I gave you guys all the resources. sacrealtor.org has a consumer tab that if you go there, click on it, it'll produce a drop-down menu that will produce the stats. So we are in June. In about one more week, it will have stats for the month of May. It's always 1 month, the prior month before's stats, every 15th, around the middle of each month. And they're pretty consistent about that. That's where your news should come from, because those are the facts locally. Those are the facts locally. So there is an article that I found very interesting that I wanted to touch upon. I'm going to talk a little bit about this, and you might hear this voice jump in every now and then. That's the voice of my very special guest today, and I'm going to introduce you to him after we take our break. But he may chime in because he's just that kind of guy.
It's possible.
I want to read this article called "How Fast is the Local Market Cooling?" Because that's something else that's trending right now. And I've talked about that here locally. So Fortune.com, a gentleman named Lance Lambert, he's the editorial director of Fortune Education. He also writes the weekly Fortune Analytics newsletter and reports on topics that range from the future of work to the housing market. So he writes, as housing data roll in for April and May, it tells us the housing market's unprecedented acceleration, which saw a record 20.6% year-over-year jump in U.S. home prices between March 2021 and March 2022, that it's either on pause or it's over. In the coming months, don't get confused by lagging home price data. All signs point toward a slowdown in the rate of home price growth. And so at Fortune, they've dubbed this shift, they are calling it the Great Deceleration. The driving force behind the Great Deceleration is the Federal Reserve. Over the past 6 months, the average 30-year fixed mortgage rate has spiked from 3.11% to 5.9%, Jeff.
That's rough.
Darn you. As the feds have moved into inflation fighting mode. Of course, that not only prices out some would-be buyers, but also sees some borrowers who must meet lenders' strict debt-to-income ratios lose their mortgage eligibility altogether. And we've seen that.
Yeah.
Buyers just basically get priced out.
Yep, they're getting priced out.
The biggest indication of cooling comes from the housing market's premier leading indicator, inventory. The pandemic's housing boom saw inventory, the number of unsold listings, fall to 4-decade lows. And I want to go to a comment that the lead analyst at Housing Wire, Logan, not sure how to pronounce his last name, Mohtashami. I'm going to say it with confidence. Logan Mohtashami.
Sounds right.
Okay, thank you. He says, for me, the best part of the housing story in 2022 is the rise in inventory, as this will put home sellers and builders in check. They had too much pricing power, and they pushed prices way too high. What are your thoughts on that?
On builders pushing prices too high?
Mm-hmm. And about inventory rising.
Well, I mean, I think a lot of it will have to do with, the cost of labor and the cost of materials. Mm-hmm. That's going to play a big role in the prices that the builders set for these new builds. Mm-hmm. So I'm really curious to see how it's going to play out.
Mm-hmm. So I am excited that his statement is saying that he's excited too about the possible rise in inventory, mm-hmm. because it is going to kind of impose a little bit of checks and balances
Yeah.
with a caveat. So he says heading into 2022 was already, Mohtashami was already on the higher mortgage rate bandwagon. I didn't say that with as much confidence as I said the first time. In his mind, it was the only way to rein in the savagely unhealthy housing market. I was saying it was almost criminal. I like his term too, savagely unhealthy. The logic, as home shoppers temporarily delay their purchase in the face of rising rates, that gives inventory the breathing room it needs to rise. When those buyers re-enter the market, in theory, they'll return to find inventory higher and feel less pressure to overbid. He says, I'm hoping that higher rates do their thing and create more balance. Back on March 23rd, Fortune labeled soaring mortgage rates a clear economic shock to the housing market. Soon after, inventory finally started to rise. That only picked up steam through April. So remember again, this story is coming from a national perspective. And they go to list housing markets that saw inventory levels rise. The biggest jumps were in Idaho, 54%, Reno, Nevada, 49.6%. Inventory, this is exciting. Bend, Oregon, 48.7%. Flagstaff, Arizona, 48.5%. And Manchester, 46.4%. But home buyers shouldn't get too excited yet. They knew I was getting excited. Yeah. While inventory levels are rising fast, percentage-wise, they're still far below pre-pandemic levels. The housing market is still savagely unhealthy because of low total inventory levels in America, he says. In order for us to return to a normal housing market, his economic models show we need to see national inventory rise to a range between 1.52 million and to 1.93 million units. The National Association of Realtors' latest reading has inventory at just 1.03 million units. So we're still millions of units behind. Hundreds of thousands of units behind. Heading forward, his biggest fear is that mortgage rates begin to fall again and the momentum is lost. If that happens, the Great Deceleration could be on pause. He says, in closing, while I'm very encouraged that inventory is rising on a year-over-year basis, we need it to stick and head a lot higher. My concern in the future is if the rates fall again, some of the inventory gains we have will go away. And I like that story because that is actually a story that is written from the perspective of what's really happening right now. It gives a very balanced perspective of we just don't know. Mm-hmm. This is what it looks like. This is what could happen. And if this happens, then this will happen. But if this happens, then this will happen.
Yeah, a lot of speculation.
A lot of speculation. So we know that interest rates right now are pushing buyers out of the market. I had this thought this morning. When I have to start actually assessing comps for my sellers differently. We look at comps based on the previous 6 months sales. The system automatically tells you this is what the comps are within the past 6 months. However, the house that closed 2 months ago or 3 months ago was bought by a buyer who had a low interest rate.
Mm-hmm.
Different interest rate. So the same priced home today, that buyer is not buying. That interest rate has priced that buyer out, today's interest rate. So I was just thinking this morning, the homes that I just put on the market within the past 7 days, I put 2 homes on the market. We are probably going to end up doing a price reduction within 30 days. And if we do it, I'm going to share this information with my sellers and say, hey, here's what's going on and here's what we need to do. So it's probably going to be a little bit of a drastic drop, but I bet you the house will get sold if we price the home according to the interest rate model.
Yeah, I think so.
Yeah. I just had that thought this morning. These are the things that I think
Yeah.
when I'm walking through having my power.
Well, no,
walk.
I mean it's a good thought. You have to price a home based on what the current market is, not a market from 2, 3, 4 months ago.
Well, you wouldn't think. I've never had to consider that before,
Yeah.
though. Normally it's whatever has happened in the past. Today it's going higher, but now we're going in reverse. So
Right.
now we have to interpret the information differently.
Yeah.
Ladies and gentlemen, you are hearing the voice of none other than Jeff Collins. He is one of my lender partners. If you go to my website at agentkey.com, click on buyers, drop down menu lender partners, and you will see Jeff's handsome face in the place. If you're watching right now, you can see his handsome face right on social media, on Facebook and on YouTube. And we're going to take a break, but when we come back, I'm going to give you all of Jeff's credentials, and I'm going to give you some news you can use, positive news you can use, because it is still possible to buy a home today.
Absolutely.
He's coming and bringing to all of you all of the programs that he has in his bag of tricks. And I also I'm going to read to you that's a cross between gonna and going. I was going to say I'm going to read to you a couple of testimonials from his clients when I read his bio.
All right.
I'm going to read that to you because it's indicative of how he has handled transactions with my clients. So you're listening to 97.5 FM KDEE. I am Agent Key here with Jeff Collins, and we'll be right back. Hey, Vincent. Good. What is that? Look. Good, great job. Good information. Oh, I was trying to read without my glasses. Can't do that. Where's my mouse? There it is. Great job. Good information. Hey, if you guys are watching, say hello. Say something in the chat and let us know you're there. You can also ask Jeff any questions if you'd like in the chat, and we will be sure to answer them. Hello there, Miss Lynn. Good afternoon. How are you? Hey, girl. So when we come back from the break, I'm going to go into your bio. Let me get rid of what I've already done. Oh, it's right here. Oh, there we are. We're in order.
I like it.
Yes. And I brought in some stats from our current market stats in the event we need to. So median sales, do you know what the median sales price right now is? Guess. Sacramento County.
507.
What?
I'm just. Am I spot on or?
Heck no!
Interest.
Median sales price hasn't been 507 for 2 years, Jeffrey. 556.
Not that far off.
You asked the person that's trying to buy a house at 507. Oh gosh. Okay.
They just need to talk to me about some of these programs.
Yeah.
I got.
Yeah. Actually, 556 was March. It's 565 because that's
Okay.
April. And inventory was 1,050, and now it's 1,342. That's good. Median days still 7. That's interesting.
Days on the market.
Mm-hmm. And in April last year, it was 6. So we've been in this crazy market like for a few years.
Mm-hmm.
Like even right before COVID, it was a crazy market. COVID just made it even crazier. Guess which price point is taking the longest time to sell?
I would assume the higher price points where less people qualify.
I don't know if I put that in the right way. For 1.7, 1. The answer to my question, you're right, yes. Hey, we're back. You're listening to 97.5 FM KDEE. I am Agent Key, and I am here with Jeff Collins, mortgage specialist.
Yes,
and I
hello.
need you to clarify something for me, because I see in your signature block Answer Home Loans and
what else?
United Wholesale Lending. Where I saw that in your bio. Should I have ignored that?
Well, I should have updated that.
Okay.
properly.
All right. It is Answer Home Loans.
Yes, it is Answer Home Loans.
Okay. All right. So let me tell you all a little bit about Jeff. With more than 10 years of experience in the industry, he consistently provides his clients at Answer Home Loans with the highest level of professionalism, integrity, industry knowledge, and attention to detail. Jeff brings a comprehensive background in advanced financial advising to the real estate industry. His business acumen, coupled with a passion for real estate and customer service, position him to deliver complete home purchasing and mortgage financing solutions to meet his clients' long-term needs. He measures his success by the confidence he earns from his clients. Providing education and consulting through the entire home buying process, it's enabled Jeff to establish strong relationships that are built on a foundation of trust and service. And I want to read a couple of quotes from people whom he's worked with. The first quote says, "I worked with Jeff to purchase my first home. He made what I thought was almost impossible work for us. We got a great rate," in all quotes, "and excellent service. He's very attentive and patient. Hold your hand and walk you through everything so that you understand what you're getting and where your money is going. He's someone you'll want in your corner. I will only work with him." And here's another one. When another lender couldn't get me the mortgage I wanted, Jeff jumped in and rescued me. Thanks to Jeff's diligent and miraculous efforts, I have the house of my dreams. I can't recommend him highly enough. And I wanted to read these two testimonials because it is something I hear consistently with the clients that Jeff has worked with. He literally, I know that there's been at least one, maybe two times that I've given you a transaction that we really needed you to rescue and find something, whether it was a better rate or not even a better rate, just to get them to the finish line.
Yeah.
That's the kind of guy that Jeff is.
Well, I appreciate that.
He will get you to the finish line. And he is here today to talk about the programs that he has. But before we jump into the programs, I want to talk about the elephant in the room, because Yahoo Finance is reporting that the purchase market has suffered from persistently low housing inventory and the jump in mortgage rates over the past 2 months. And they're saying these worsening affordability challenges have been particularly hard on prospective first-time buyers. What are your thoughts on that? What are you seeing as interest rates climb?
Yeah, so the main thing that we're seeing as interest rates climb are clients struggling to get approved for the houses that they could get approved for a few months ago. We're seeing, people who are approved for, maybe 550,000. Now they're only approved for 500,000 or 480, right? It's brought a lot of people down as far as what their purchase power is.
Yeah.
We're seeing, this is kind of like a sliding scale, but between 100,000 to 150,000 in purchase power lost.
Wow.
Which is really significant, especially with home prices still climbing.
Yeah, that puts people in an entirely different neighborhood.
Absolutely.
So, and I can imagine someone being discouraged and just pressing pause on the process.
Yeah, we're seeing some people press pause, definitely, kind of trying to wait out the market, but it's hard because we're in a market that a lot of people haven't seen before, so it's hard to predict or determine, how it's going to play out.
How are you advising your clients that want to press pause? What's been your response when they say we're tapping out?
If they want to tap out, I'm not really in the business of forcing people to buy houses when they don't want to, or if they feel like they're not ready. I just like to give them, the most accurate information I can, so that way they can make the best decision for themselves and their family.
Yeah.
You know, if it's time for them to push pause for whatever reason, you know, I try to listen to that reason. I try to offer insight, whether, you know, it's, you know, nudging them if I can tell that, you know, maybe they want to, but they're kind of hesitant, maybe nudging them, or if they're, you know, set on waiting and, you know, for other reasons, you know, I support what they want to do because I don't want to force them or pressure them into purchasing a house in maybe a market they don't want to, or, you know, for whatever reason. I just don't want to pressure them.
Now, are you still staying in contact with them? This is a...
Oh, yeah, absolutely. Yeah.
How are you doing?
Well, it depends. You know, it depends on you know, how well I know the client. You know, if it's someone that I know personally, you know, phone calls or text messages. Sometimes it's through emails. If I send an email about some information and I don't get a response back, I might follow up the email with a text message or a phone call a couple of days later, you know, just to make sure that they're, you know, up to speed on what's going on with the market.
And the reason I ask that question is because I want people to hear the type of service that you provide, even if they have decided not to move forward.
Yeah. Well, I always feel like, you know, people can make the best decision if they have the most information.
Right.
So I try to just give, you know, information as I learn it as well. Try to pass that along.
Yeah, I think we're in the same boat there. I'm telling my clients also, I just got an email last night from one that they've decided to wait. And I try to turn it into positive because it is, because waiting, there are benefits to waiting. Oh, well, while you wait, this is going to be great because it looks like the market, and it is turning in your favor. Granted, it's a slow cruise ship turn. It's not a fast turn.
Very slow turn.
It's a very slow turn. But eventually, once it gets turned around, it will more than likely be in a buyer's favor. And then in addition, time allows for things to improve. You know, they can save a little bit more money.
Exactly.
Improve the credit score a little bit more.
Yep, exactly.
Right? So those are the types of pieces of information that we like sharing. So I want you to take this time, though, to talk about those buyers who are keeping a little dog in the game, those buyers who want to have a dog in the game right now. What home buyer loan options do you have available?
Yeah, so there's quite a few. And a lot of these home buyer, these loan options that I'm going to talk about are for first-time home buyers. So I kind of want to define what a first-time home buyer is.
Oh.
But
well, then give me this back.
Okay.
I was trying to slide him the notes, y'all. He has his own.
I got my own notes. But yeah, so a first-time home buyer is essentially someone who hasn't owned a home in the last 3 years. So it's important to define that because some people who owned a home 5 years ago now qualify as a first-time home buyer. So I want to, you know, make sure that everybody is aware of that. So one of the programs that I want to talk about is a down payment assistance program through Cal HFA. And it's a good program for someone who, you know, has a credit score of at least, I want to say 640 for an FHA loan, or 660 for a conventional loan. And they have good income, a steady job, but they just don't have funds for a down payment. This program offers them either 3% for their down payment for a conventional loan or 3.5% for the down payment for an FHA loan. And then we also have an option to offer them a 2% or 3% third loan to help with closing costs as well.
Nice.
So it's a great option because a lot of people's hurdle is coming up with the funds for the down payment. There's a lot of people out there who have a good job or good credit, low debt, but they just don't have the funds saved up. It's hard to save $10,000 or $15,000. It's a challenge.
Right.
And so it's a great program because, you know, we're able to give them the funds for the down payment and then, you know, the third loan for the closing costs. It doesn't cover all the closing costs, but it helps tremendously.
Right, where they're not coming in with thousands, tens and 20,000, but maybe a few thousand.
I mean, to set the proper expectations, it can be about $5,000 or so that they have to come in with. But I mean,
which is a much easier jump when it comes to saving.
Exactly, yeah. And in the grand scheme of things, you know, when you're buying a house, coming in with only $5,000 is huge.
Right, very nice.
Yeah. So we've got another program. This one's called Home Ready and Home Possible. These are programs that came out through Fannie Mae and Freddie Mac. These allow you to put down as little as 3% as a first-time home buyer. And the catch with these programs is there's an income limit. So in Sacramento County and Placer County, the income limit, I want to say it's about 72,700, right around there. But so it makes it a little bit challenging to qualify, right? Because you have to make enough money to qualify for the house, but you also
Can't exceed the income
you can't
limit.
exceed the income limit, exactly. So the cool thing about this program, though, is it allows you to put 3% down, but it also offers a lower interest rate than a standard conventional loan.
Nice.
And it also offers lower mortgage insurance.
I don't mean to put you on the spot with this one, but have you developed a profile for the person that would qualify for that? Like, what's that house purchase price point?
Yeah, I'm trying to think of the last time I did one of these loans. I want to say we're probably in the mid 4s.
Oh, that's nice.
Yeah.
At that lower rate.
Mm-hmm.
Okay.
Yeah, because it's the lower rate that makes the difference, right? So the catch with these Cal HFA programs is the interest rate is about, it fluctuates sometimes, but I think right now we're at about 6.625,
Which
and that's
crazy.
That's going to skyrocket your debt to income ratio.
Yeah.
In addition, the Cal HFA programs will cap you at a 45% debt to income ratio.
Okay.
Versus Home Ready, where you can go up to 50%.
This is great. Yeah.
So you get a little bit more wiggle room on the debt to income ratio, and then you also get a better interest rate and better mortgage insurance, which helps your debt to income ratio stay lower.
Okay.
So it's a great program.
We got to figure out that buyer profile, because I like the idea of the lower rate and the higher debt to income ratio.
Yeah.
We can get some people into that one.
Yeah, definitely. I mean, as long as someone, well, so these are conventional loans, right?
Mm-hmm.
So we're going to want to have a score. I mean, we can probably get it approved with a FICO as low as 660, but we're going to want to see them a little bit higher. That's where we're going to get the benefits of, 680, closer to 7. Mm-hmm. Even, if you can be at 720 or 740, you're really going to see the benefits of the lower rates and the lower PMI, especially.
So the person with a higher credit score who is at, you said 72,000.
Yeah, it's about 72,700.
If you're making about the low 70,000 a year, if you're listening, you're making in the low 70,000 a year. You got great credit, 700 or pushing to 700.
Yeah, close to 700.
What other things would this person look like?
They would have 3% down.
3% down,
and
we're looking
funds
at
for closing costs as well.
And so the 4%, the $400,000 purchase point would mean they need to have at least 12,000.
Exactly.
So they have to have some money saved up, and using this. So this 3% down program is helping them with the down, or what is it helping them?
No,
with?
It doesn't help them with the down payment. It just helps. It allows them to use a conventional loan and put down only 3%, whereas in another conventional loan you have to put down 5%.
Got it. So they can get so the benefit of this program is the great rate.
Yeah, it's a good rate, and it's the lower down payment for a conventional loan.
And lower down payment. Okay. So if you're listening and you want the lower down payment for a conventional, so let's talk about the benefits, the benefit of a conventional versus FHA.
Okay.
So I can tell you all right now, one of the big benefits where this would excite me is that sometimes there are homes that have been flipped. And if you are an FHA buyer, you are not eligible to make an offer on a home that's been flipped for the first 90 days because of something called the 90-day flip rule.
Yeah.
And where FHA is looking out to make sure that prices don't change drastically and you get stuck in a home that's going to put you underwater. The rationale is on point, but when you have a home out there that's been flipped and inventory is low, it limits your options when you find a house that you fall in love with and you can't make an offer, especially when people, you can't get new home construction, but you can possibly get something that's been completely remodeled.
Yeah.
So if you are looking to purchase a home that's been completely remodeled and you're an FHA buyer and you've been shut out because of that reason, then this would be the perfect loan product for you if you have that higher credit score and the money down.
Yeah.
Okay.
Yeah, it's a great option. And now another option, loan option that we have is an FHA loan. It's the good thing that I like about FHA loans is it allows for people with challenging credit to still get approved. And FHA loans offer a lower interest rate than a conventional loan. However, on an FHA loan, you have to have PMI, and it's at a rate of 0.85%, whereas on a conventional loan, it could be as high as 0.85% depending on your credit score, but it's a sliding scale. So 0.85%, or if you have, a 720 or 740, the PMI will be drastically reduced. So you can end up with a higher payment on
now,
an
when
FHA
you talk
loan.
Explain to people who may not know what PMI is.
Mortgage insurance.
And how does that affect your monthly payment?
Yeah, so mortgage insurance is basically something that you need if you don't put 20% down. So every loan, I don't want to say every loan because there are programs that don't necessarily require it, but the majority of the time it's required if you put less than 20% down. And what it does is it's there for the lender. It's to protect the lender in case you go into default, foreclosure, or whatever, and make sure that the lender gets their money. So,
and it can add sometimes how much?
Yeah, I mean, depending on your price point, it can add anywhere from $250. I've seen it up to $500-$600 sometimes per month. Yeah,
to the mortgage amount, to the monthly mortgage.
Yeah.
So without PMI, if you had a monthly mortgage of $2,200 a month, with PMI, that could be as much as $2,600 a month. Yeah. So getting into one of these loan programs that does not have PMI saves you quite a few $100s a month.
Yeah. Well, the good news though is on an FHA loan, it's standard, right? It's 0.85%, and that's it. So even if you have more challenging credit, it's still going to be 0.85%. Whereas on a conventional loan, it's kind of a sliding scale.
And one of the benefits that homeowners can look forward to is that the longer they stay in their home and they accrue or gain equity, then they can possibly refinance.
Yeah, they can refinance out of that loan and get into a different loan. If they've achieved 20% equity, they can refinance, and the new loan will not have the mortgage insurance, and that'll drastically bring the payment down. Along with in a different market, a lower interest rate, but we're not in that market right now.
Right. We're talking about this one.
Yeah.
I think the idea is that there are a lot of tips and tricks and tools that can be used as you enter into the mortgage market. Before you continue, Jeff, there was a question by one of our viewers. Vincent said he's curious to know, Jeff, insight in mortgage rates in the next 16 months.
I mean, that's a good question, and I think that's a question that a lot of lenders are getting right now. It's hard to say. Ideally, as a lender, I'd like to see them go down, right? I think as consumers, we'd like to see them go down. I think everyone in general does. But the feds have increased, the Fed fund rate, and
are they talking about decreasing, or are they talking about increasing?
Increasing still. Yeah. So we could see them go up. However, I do feel like a lot of lenders kind of already priced that in, which is why we saw such a quick
increase in mortgage rates.
Increase in the rates. But I mean, in the next 16 months or so, let's say year to a year and a half, I've heard from some people who have been in the industry for a long time that we're going to see interest rates get worse before we see them get better. So over the next, few months or so, we might see another increase, and then we might see a dip. But again, it's all speculation. We're in a weird economy. We're in a weird market. So there's a lot of factors that just, it's hard to predict.
Right, because a lot of it has to do with what the current economy is doing and the things that are happening at that present moment in time, not just here nationally, but worldwide.
Right.
And so they're assessing things from angles that are happening at that time point in history. We don't know where we're going to be 6 months from now. We don't know what's going to be happening wherever, monkeypox is on the rise. Oh my gosh, monkeypox. But Lord, I'm just playing. Hopefully it does not turn into anything crazy.
We're joking.
Right. Yeah. So continue. Thank you.
Yeah. So but yeah, I mean, just to put an answer to that question, I would say, the we're going to see rates go up a little bit before we see them come down, and then we'll level off. I think everything is going to level off eventually. I just think it's going to take some time for it to get there.
Okay.
We were in such an aggressive market over the last 2 years.
Yeah.
It was unsustainable.
Right.
So now
and the rates were lowered. We have to remember they reduced the rates in order to stimulate the economy because of COVID.
Right.
Everybody sheltered and hunkered down, and because of the everything just keeps playing off of everything else. We have limited inventory because of the fiasco of the market crisis, and they just put a halt to constructing after all of that happened, because there would have been a surplus of inventory at a time when people were losing their homes left and right. And so as a result of that, the builders left the industry, or the ones that were actually doing the work. They had to find other career fields and a lot of things. Just so that is what caused the lack of inventory, and that's why we see it nationwide, not just here in Sacramento, because it was a nationwide phenomena when the market crashed. So to get back on board, it's going to take us some time. They're estimating like 5 to 10 years before we start seeing a normal market.
Well, I'm ready for the ride.
Yeah.
Whatever it is,
What other choice do we have?
Yeah. So whatever the market is, I'm here. So, all right. So the next loan that I want to talk about is one of my favorite loans out there, and it's called a VA loan. It's for all the veterans out there, and I think it's one of the best products out there because it allows the veterans to purchase a home with no down payment and no mortgage insurance, and it has a great rate. So it's kind of like our way to give back. Right. So I love doing those loans. It makes me feel good because I want to thank them for their service. They're so deserving, and the fact that they're able to come in and purchase a home. And
so this would really be a great time for veterans to buy. Yeah,
it would be a good time to buy. Yeah, absolutely, with no money down, no PMI, and the interest rate is,
they always have the best.
They have the best rates, and the debt to income ratio is a lot more flexible. There really isn't a hard cap on a VA loan. So it just depends on the risk profile of the person or the scenario. But we can get those approved, up to pretty high debt to income ratios. I've seen them, 60s sometimes. I've heard of them going higher than that, but that's specific to certain scenarios. But so it's just a great program for the veterans.
This would be a great time for you to share your contact information before we take a break.
Yeah. So you can reach me. My phone number is the best way to contact me. You can either text or call. That's 925-381-3536. You can also go to my website, which is www.jeffcollinshomeloans.com. I've got social media, facebook.com/JeffCollins, Home Loans. I think that's it.
And give your phone number one more time.
That number is 925-381-3536. In fact, you can text me now and I'll read your text message on air.
And that's Collins, Collins.
That's it.
Jeff Collins. Ladies and gentlemen, you're listening to 97.5 FM KDEE. I'm Agent Key here with Jeff Collins, Collins. And we will be right back. Hey. Hello, Leon. I see you, sir. How you doing? Miss Kelly. Hola, señorita. Miss Lynn. Oh, another Leon. I was talking about Leon right here.
Yeah.
I didn't. The coincidence of it all.
That's my favorite 97.5 voice.
Well, you know. Oh, wow.
I know what yours, but he just got the sound.
I don't have a radio voice.
You do. You just are afraid of it.
I'm afraid of it?
Yeah, I don't know why.
Okay. So maybe I should take classes. Leon? Oh.
Outstanding. Trust me when I tell you.
You know what? It's funny because I think after the fact, that sometimes during the show I go too high, because even when I'm talking to people, sometimes when I talk to ladies whose voices go to what I call the rafters, I get annoyed.
Yeah.
And then I think I do that, and I need to be aware,
Yeah.
because
The
radio
difference is
voice,
those
you don't go into the rafters.
You want
don't
that
know.
deep.
Yes.
Difference is
And I
all
don't.
passion, though, right?
I do it right when I come on the air. You're listening to 97.5 FM KDE.
Because
You
you
know?
think too much. Because if you're talking like you were, you're talking to deaf now.
I know. See, like right now.
Yeah, that's what I mean. Because you're thinking about
So
it.
I have to constantly. Well,
I do
but
the
I
same
have
thing.
to think about it.
Literally.
Yeah.
I do it all the time. My wife says I have a YouTube voice when I'm doing a video. Even though there's nobody around and I'm holding a camera, my voice changes.
Yeah.
And she goes, "Oh, your YouTube voice." Right? And I'm like, I guess I have a YouTube voice.
You do though.
hmm
Now that you say that.
Yeah.
So I think my radio voice comes from someplace I have to practice using it, even when I'm just having regular conversations.
Yeah.
Yeah, but then you sound phony.
I don't understand what you mean.
I think we should
No,
practice our radio
I think
voice.
the
Yes.
tone, I really think the
Practice
tone that
makes
she
perfect.
uses is okay.
The,
See,
the tone that I use is okay.
Not that.
Which tone do you prefer?
Your natural tone. That's the thing right there. I'm like, okay, where's this shadow button at?
Wait, so this tone
Yeah. The other
sounds good for radio.
thing, absolutely.
Okay.
To me,
Okay.
yeah.
I don't
me,
have to
sounds
go
good.
reaching somewhere
And
else.
if you, even if you listen to Charmaine, who's been doing it for a long time,
Uh-huh.
she don't go way down there.
Okay.
You know,
Okay.
the people that you hear down there, their voices down there naturally.
Mm-hmm.
So why would you want to, you know?
So am I already tapping into my radio voice?
Absolutely.
Then why'd you say what you said about me?
What did I say?
That you don't like my radio voice.
I
You
did
like
not say
Leon's
that.
radio voice
I did not say
better
that.
than mine.
I didn't hear him say that.
It's
And I
recording.
didn't say
I'll
that.
go back and.
Please record it. 'Cause I didn't say that.
Okay, we're coming back.
You got 2 seconds.
Okay.
Go.
Ladies and gentlemen, we're back. You're listening to 97.5 FM KDEE. I'm talking in my radio voice. Okay. All right. So we have with us Jeff Collins from
Answer
Home Loans,
That's
to
it.
catch myself. And he just gave us several loan options that you can use right now. And I want to let him continue with we have about 5 more minutes. And I
About
want
5
you
more
to
minutes.
get
Sure.
in as many as you can so people can hear what they might potentially qualify for.
Sure. Yeah. So the ones that we went over, those were basically first-time home buyer ones. So we're going to get into your more standard loans. So just in general, we've got conventional loans, which if you're not a first-time home buyer, you would put down 5%. And that's a good loan. It's a good loan in the market now because even though we still have we're having multiple offers, a conventional loan stands out over an FHA loan and sometimes even over a VA loan.
That's true.
So if you can come in strong with a conventional loan, it's a great program to help get your offer accepted.
Mhm.
But when we talk about the Home Ready and Home Possible, which allow you to put down the 3%, those are also conventional loans.
Right.
So they stand out as well.
That's a
Two.
good point.
And then when you get into the high balance loan limits, which is $647,200, that's when you're required to put down 5% as well.
Mhm.
And that's just for your higher price point,
Okay.
essentially.
Okay.
We've got a couple other loan programs here. I think one of the ones that I want to talk about is a bank statement loan.
Mm.
I think that's an advantageous program to someone who is self-employed because generally self-employed people tend to have a lot of write-offs.
Mhm.
And so when we look at someone's tax returns who's self-employed and their gross income is fantastic, but their
Mhm.
net income, which is what we go off of, generally tends to be lower than what's acceptable to get approved.
What advice do you have for that person who's self-employed? Because the COVID situation created a lot of new self-employed folks.
It did.
So
Yeah.
self-employed people who want to eventually become homeowners, what advice do you have for them?
I mean, it's tough to say, because when it comes to getting qualified, you have to show income. And if you're going to show income, you have to pay taxes on that income. So it's kind of a catch-22 because you have to show the income and then you have to pay taxes on the income. Now you have less money, but you qualify for more. So A lot of times, I talk to my clients who are self-employed, and we kind of find that sweet spot of here's what you need to qualify. And so you only have to pay this much instead of overqualifying and overpaying.
Mm-hmm.
So
what you're saying is they need to schedule an appointment with you.
Absolutely.
So you can help find that sweet spot.
We can find the sweet spot of how much income to show.
Yes.
Yes, absolutely. But the bank statement loan is great because we're able to qualify off of incoming deposits in the bank account. So we look at those and we determine, which ones are business deposits, and we are able to use that as income. And we average it over a 12-month period. So we get 12 months of bank statements. We calculate all the deposits and we divide it by 12, and that gives them their qualifiable income. And we don't have to look at their tax returns. We just go off of the bank statement. So the catch is it requires a greater down payment. I think we can do them as low as 10% down.
Mm-hmm.
For the better interest rate, you're going to want 20% down.
Mm-hmm.
And the interest rates are higher. They're, 7-8%, right around there. But if you don't qualify and this is your only option, this is a great way to go.
So this is for the listener who is making a ton of money and forgetting to pay their taxes.
Well, not so much forgetting, just writing off more than what's acceptable to get approved.
That part too. Thank you. Yes. That too.
Yeah. The next loan we have is a Dscr loan.
Mm-hmm.
And basically that stands for debt service coverage ratio. It's for investors only. And the way that you qualify, basically the income that's coming in on this investment property has to exceed your principal, your interest, your taxes, and insurance by $1. If it exceeds it by $1, it qualifies.
Wow.
So yeah, it's a cool loan. Now you do need, you can put as little as 20% down. It's hard though, because, it depends on how much you can rent the property out for. So we've got to get the loan amount down low enough so that way the rent can cover that amount. So sometimes we can get away with 20% down. Ideally, we'd like to see 25% down. And then obviously the more you put down, the easier it is to qualify. Nice.
That's very nice.
And then the last loan I want to talk about is a stated income loan. We do have stated income loans. They are back. There's no income documents needed. You state your income on your loan app. Requires 20% down with a 740 FICO or higher.
Okay.
We can do it as low as a 660 credit score, but you're going to need a much greater down payment. We're talking like probably 50%.
So this is the one where I really should have said when you're making tons of money.
Well, it's stated income. I guess you can say you're making tons of money.
That's true. Yeah, you don't. Yeah. Well,
right?
When you have all this money and you don't really know where it came from. But I wanted to go back to the bank statement loan, because that really is the COVID situation. The pandemic did create a whole new batch of self-employed folks who really were wanting to write off as much as possible.
Yeah, they want to keep their money.
To keep more money. And so through this bank statement loan, this is very, very beneficial for those folks. And I know that there are a lot of folks out there who've gone to a lender and the lender has asked for the tax returns and the tax returns don't show the income.
Yeah, they don't show what we need.
What is your contact information? Because someone out there needs to schedule some time with you.
Yeah, give me a call. The number is 925-381-3536, or on my website, which is www.jeffcollinshomeloans.com.
Okay. And I want you to give some final thoughts, if you have any, to buyers out there, some words of hope.
Yeah, I think the best advice I can give is if you're considering buying a home, and even if you're not considering, it's worth a phone call to find out what you qualify for. Because let's say you only qualify for maybe $300,000. At least we know that's our starting point. And I can advise you on what needs to happen to get the pre-approval amount higher, right? Or you may find out that you qualify for $600,000 and you didn't know, you know?
Yeah.
So, for anyone who's considering or not considering, let's find out. And if it makes sense, then it's time to buy. I like to tell people, if you can afford the monthly payment, that's the right time to buy.
There it is. Ladies and gents, you've been listening to 97.5 FM KDEE, Jeff Thank you so much for taking the time to come
Absolutely.
today. It's
Thank
so
you for
good to
having
see
me.
you.
Yeah.
Haven't seen
It's
you
been
in a
too long.
while. I know. And you all know that if you are doing what you were created to do, I will see you at the top.
I like that.
There's got to be a Santa Claus somewhere. Oh, maybe. Hey, girl.
You know what? You try to get on my list. Hey, everybody. Thank you for tuning in today. And we will see y'all next time. You know what time it is. Time for me to go find. No, I was going to say tacos, but you know what I made yesterday? I made a delicious dinner that I'm going to go home to and get.
I saw
some.
that. Was that?
The tortellini with the
Yes,
spinach and the
yeah,
roasted
I saw
Roma
that.
tomatoes.
I saw that.
They're waiting for me.
Chef Taylor.
I
Yeah.
am. Yeah. You know, when you have your mind all set on something.
Oh, yes.
I did make a little diet blender last night. I went to the grocery store and bought all this great food, fruits and vegetables and grains and fish. And, you know, my basket was looking all. And then the carrot cake called me over in the bakery.
Ooh, I understand.
Carrots are healthy.
That's what I said.
I understand.
Was that a carrot in the form of a cake?
Yes.
I was tempted yesterday, too. I stopped at, oh, my God, Cheesecake Factory, which was a no-no. Oh, but
Oh,
I had a salad. And on the way out, man, that
banana
cheesecake
cheesecake?
was calling me like,
Bananas
over
are
here.
healthy.
I know it. I was like, woo.
And
It just
cheese,
was
cheese is full of good fats.
I was gonna
Good
say-
healthy fats.
bananas and cheese.
But I was like, ooh, okay.
Did you eat the whole slice?
I didn't even know.
Oh, you did? Oh, you were so
Well,
good.
I was, but I was crying all the way home. Oh,
I bought the carrot cake
Yeah.
when I got home and I put away all the groceries. I could not find the carrot cake. I pulled up my receipt to make sure I had paid for it. I'm looking at all the groceries and it said carrot cake. I had paid for it. And I go and I pull out all of my, because I buy these protein waffles. They were on sale. So I had stacks of them. And underneath was the carrot cake. I was like,
Was
woo!
it squished?
It wasn't squished.
Oh, okay.
But it was like after 8 o'clock, I was gonna hop in my car and go back to the store.
Right.
And then at that moment, I was like, "This is crazy.
Yeah.
This is crazy."
No, I mean you had your mind made up. Like that carrot cake was.
You had your mouth all fixed.
Right.
My mouth was fixed. And I was like, "Oh my god, I can't
Yeah.
find the carrot cake. It's not in here
I was like,
nowhere."
get out of here.
Oh my gosh.
I do that with the dairy-free ice cream.
Mm-hmm.
Right? Since I'm lactose intolerant, my whole life I grew up not eating ice cream, not eating cake.
So
Now there's vegan cake, there's almond milk ice cream, coconut milk ice cream. I'm like, ooh, okay, it's got to be healthy. It's made from almonds, and it's not.
Do you like it?
Do I? In fact, when I compare the two, I think I prefer the dairy-free ice creams
Oh, really?
over dairy ice cream. Yeah.
What brand do you buy?
I really like Ben and Jerry's. They
They
have
have
all
a dairy
these.
free?
Yeah, they have all these crazy flavors. Netflix and chilled.
Ben and Jerry's?
Ben and Jerry's non-dairy. The Netflix and chilled. It's like kind of like a caramely, but then like salty, pretzel-y, kind of with little like brownie bite. I mean, it's.
Oh my gosh!
it's
I
too
might have to
much.
try that because
Yeah.
I can't. I probably have ice cream maybe a couple times a year because it just doesn't, doesn't function through me the same way.
Yeah, that's that dairy. Yeah.
So I'll have to go check that
Yeah,
out.
and if
Oh, hey y'all! I said I was going to take off here. Bye, you guys. See you next week.
And for the record,